Earlier this week, I bought more shares of 7 REITs that I believe are heavily discounted and offer significant upside potential in addition to a high dividend yield. In today's video, I'm not going to highlight all 7 of them because the video will get too long, but instead I'm going to highlight one specific opportunity that I really think you shouldn't miss. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and today I'm gonna talk to you about Crown Castle, which is slowly becoming one of my largest holdings. But before I get into it, please note that you can access my full report on Crown Castle as well as all my other transactions in real time by joining my REIT newsletter High Yield Landlord for a 2-week free trial. I'll put a link to it somewhere in the description. So previously on this channel, I've described Crown Castle, ticker symbol CCI, as the highest yielding blue chip in today's REIT market. I like to call it a blue chip because it owns a high quality portfolio of defensive cell towers, it has a fortress investment grade rated balance sheet, it has a very good management team that has one of the best track records in the entire REIT sector, and then it's expected to keep growing its cash flow very consistently and at a rapid rate over the long run. For these reasons, this REIT has typically been priced at a relatively low yield and a high valuation. Just a couple of years ago, it was priced at over 20 times FFO, it was yielding just around 3%, but today you can buy it at just 13 times FFO and a 6.3% dividend yield, which is the highest yield ever for the company. I thought that this was a good deal when its yield started surpassing 5%, and so today at a 6.3% dividend yield, I'm buying a lot more shares. So why is it so cheap right now? The first reason is that the company is going to suffer a slowdown in its growth rate over the next 2 years. The management has been very transparent about this on their conference calls. They explain that their growth is going to slow down as a result of some lease cancellations that will occur because of T-Mobile's recent acquisition of Sprint. I agree that a slowdown in growth would justify a lower valuation, but where I disagree with the market is really the magnitude of this discount. The market has now repriced Crown Castle as if its growth was completely over, when in reality I think that its growth is going to rapidly reaccelerate past 2025. That's when the impact of these lease cancellations will end, and the management has made it very clear that they plan to return to a 7 to 8% dividend per share growth rate in 2026. So put simply, this is a temporary issue for the REIT. Its growth will slow down for 2 years, but it doesn't change the long-term growth prospects of the company. In an efficient market, you would expect the REIT to be priced based on decades of expected future cash flow, and therefore the impact of just 2 years really shouldn't be that significant. But because most investors are so short-term oriented, caring mostly about the next quarter, the next year, or at most the next 2 years, the REIT has now been repriced at an exceptionally low valuation. Before I continue, could you please do me a favor and like this video? It really helped me a lot to grow the channel. Thank you very much for your support. Then the second reason why we've seen the valuation of Crown Castle contract so much is the surge of interest rates. This has impacted the market sentiment of every REIT, but I think that has impacted Crown Castle even more than the average. The market worries that because Crown Castle's net operating income will stagnate as a result of these lease cancellations, it won't be able to make up for the surge in interest rates, causing its cash flow to decrease. But what the market here appears to have overlooked is that Crown Castle has a BBB investment grade rated balance sheet with low debt, long debt maturities, mostly fixed rate debt, and as a result the impact really won't be significant. Once more, the management has made it very clear in their recent conference calls that they are confident that they can return to a 7 to 8% dividend per share growth rate in past 2025, and this is coming from a management team that has really delivered excellent returns and excellent dividend growth over the past years. So to recap all of this, now you get to buy this very defensive blue chip with very attractive long-term growth prospects at a historically low valuation because of a temporary slowdown in its growth rate. Typically the REIT will be priced at a roughly 3% dividend yield, which makes sense since it's been able to grow its dividend at 7 to 8%. However, today you can buy it at a 6.3% dividend yield. You will have 2 years of slow growth or even no growth, but beyond that they will return to a 7 to 8% dividend per share growth rate, and when you add these two get together, this 6.3% dividend yield and 8% growth rate, you get to nearly 15% average annual total returns. That's assuming that its valuation multiple remains intact, but I actually think that as its growth reaccelerates, the market market is also going to reprice it at a materially higher valuation. Historically, the REIT has commonly traded at closer to 25 times FFO. That's nearly the double of today's multiple. But even if it returns to just 20 times FFO, that would unlock about 50% upside from here. And so what I really like about this REIT is that you have a compelling case for significant returns over the coming years, and it's coming from a relatively safe REIT, and you also have a very strong catalyst in place to earn this upside, and this catalyst is the reacceleration in its growth, which the management is very confident that they will achieve. I have bought a lot of shares in recent weeks, and I expect to keep accumulating a larger position as long as it remains discounted, because I think that this is one of the best opportunities in today's REIT market. Now, if you want to learn more about the 6 other REITs that I bought earlier this week, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. This is a no commitment free trial, meaning that you won't have to pay anything before it expires. You can cancel it anytime. So if you just want to come for the free trial, that's perfectly fine. I'll put a link somewhere in the description of this video. Otherwise, if you could please make me a favor and like this video, that will really help me a lot to grow this channel. Thank you very much again for your support, and see you at my next one. Bye bye.